Have you watched my previous video to buy or not to buy, the confirmation and what to do next? Are banks a strong sell now? Well, looks like we've got a further confirmation as far as the banks and what not to do. Also, my video before that, history in the making, something big is coming and I think they know it. Why January 18th, 2020? I got a very interesting comment in the comment section, obviously, on that video. Also, we know that the Reserve Bank of Australia, RBA, has cut interest rates to record lows of 0.75%. What has that done to the consumer confidence? Here's some of the monthly figures. This is current. Why? We'll get into that. But first, are banks a strong sell now, or at least not a buy? So if one is to form an opinion, not financial advice, you would be either selling the banks that you already have or definitely not buying if you're looking to add to your stock market portfolio. You also want to think about your superannuation, and if you haven't touched it, it would probably be in a moderate, which would be heavily weighed most likely towards domestic shares here in Australia, and there would be heavily weighed towards Australian banks. So I would be probably calling my superannuation fund and asking them that. And if that's the case, I would probably go a little bit more conservative in the next few months, maybe 6 or even up to 12 months, just to be on the safe side. And definitely that way get out of the banks.
Bad banks and bad management. Bill for ripping off customers set to top $10 billion. No guarantees it's over.
The compensation, I think, is just the tip of the iceberg.
Now, I know it's a main street TV and a mainstream media being ABC in Australia here, Australian Broadcasting Corporation, owned by the government, by us, funded by us. But I didn't say it. This is what they said.
Bank shareholders are set to wear a lot more pain from last year's Royal Commission, with at least one analyst tipping that ANZ by itself could end up paying more than $2 billion. The bill for the whole industry could be over $10 billion, and no one is prepared to say the price gouging and bad behaviour by the banks is over.
So who's up for a haircut?
Bank shareholders are set to wear a lot more pain from last year's Royal Commission.
So bank shareholders, once again, there's many ways to be in the bank shares, and one of the kind of hidden ways that you don't normally think about is through your superannuation.
Bad management has led to the destruction of more than $10 billion of shareholder money.
So, so who is going to get ripped off? The shareholders. And to minimize the shareholder pain, the banks as businesses, there's only two ways to go about it, is to pass on the cost to the shareholders, which will happen, and part of it will have to be passed on to the consumers, meaning that when the RBA cuts interest rates, official interest cash rate, down even further, they're not going to pass it in full, and also the savers will definitely continue to suffer even more. So look at that. $10.22 billion. So this is $10,000 million and some change. Just for this compensation bill for the Royal Commission, that, as I stated before, they probably threw a lot of the other costs and losses and stuff ups by management and banks into that so they can claim it and write it off on tax. This is just my guess. But I know I'd be doing it if I was a bank. So I think they're a lot smarter and they've got a lot more smarter people working from them. And collectively, they would probably want to make that decision without obviously breaking the tax law, but definitely bending it. And next are very succinct and wise words.
We can't be confident that it won't happen again. It may happen again.
The people that told us there was nothing to find are the same people that are now telling us there's nothing more to find. The only people that have credibility here are the ones that were calling for the Royal Commission, and the people that have the least credibility are the ones that said we didn't need one.
How good was that? Hat tip to Richard Dennis of the Australian Institute, or the Australia Institute. And of course, this gentleman, Brett Lamassu of Shaw M Partners. And remember this picture for a little while ago? Smiles and not so much over there. So I was wrong in my last video where I said or posed the question and pretty much positively alluding and implying that banks are a strong sell potentially right now. Well, I think I was wrong. They are insanely strong sell or don't buy at the moment, in my opinion only. So I wouldn't go there, even with somebody else's money. Now, before we go into consumer confidence, given all this rate cutting by Reserve Bank of Australia, I was arming and ahhing whether I should read this comment. It is from a channel that has 52.8 thousand subscribers. The topic of that channel is astrology. And before we make any judgment about it, I don't know much about astrology. I used to think and potentially still think that it's a bit of a tea leaf reading. Such is the predicting the cycles of the property and the stock market and the banks. So we're on the same or in the same business really. So we can't knock one or elevate one above the other. We're all just guessing unless we have a computer model in ultimately I believe in the Martin Armstrong's computer model, economic confidence model, ECM. But that's a different topic. I have touched upon that on many of my other videos. So the YouTube channel 33, number 33 says, please look into the much anticipated Pluto-Saturn conjunction taking place in mid-January 2020, I think it means. We astrologers have been counting down the days for the past 10 years. The free ride is over. It's time the world spends within its means. And then there's a quote, millionaires don't use astrology, billionaires do. Apparently, it was said by JP Morgan, who, by the way, wasn't a billionaire. Okay, in back then, that money, I don't think he was still a millionaire. He was surprisingly not all that rich. Probably hundreds of millions of dollars in today's money, which is not short change or small change. Nevertheless, I digress. So millionaires don't use astrology, billionaires do, according to Channel 33. And there's a much anticipated Pluto-Saturn conjunction taking place in the mid-January. This once again is in regards to my video, History in the Making. Something big is coming and I think they know it. Why 18th of January 2020? So this is the video, 2 videos prior to this one. So I'll place it in the description box as well for you to easily find it. Otherwise, you can just subscribe to my channel, have a look at the videos. It'll be the 3rd one down once I upload this one. And how astrology says mid-January 2020 and Martin Armstrong says 18th of January, very precise, 2020. All right, now it's about the consumer confidence as promised. I do have a quick segment at the end of it as a little bonus and surprise. But okay, so let's have a look at the consumer confidence in the last 12 months. So you can see that the trend is down. It's definitely down. So we know that in July it was 96.5. It was 100 in August, then September 98.2, and then look at that, 92.8 for October. But they've been cutting interest rates, so that must have made it easier for borrowers, including private debt in credit cards, small businesses, large businesses. I'm sure that part of this consumer confidence surveys, there are some managers that have small businesses or are managers part of big businesses and purchasing managers who can get the kind of the feeling within the business, not just their own pockets, and see how confident they are going forward. I think the RBA is cutting interest rates down to a record 0.75% low historically, I think ever, has probably spooked everyone thinking something's not right. Interest rates now are way below the emergency interest rates that were instilled or installed during the global financial crisis in 2008-9. So if that was emergency levels, what is it now?
Interest rate cuts and cashed up tax returns have done little to boost household confidence, with sentiment levels at more than 4-year lows. The latest consumer confidence survey slumped 5.5% to levels not seen since July 2015. In fact, sentiment has deteriorated over 8% since the Reserve Bank started cutting rates again back in June.
The surprise fall this month came despite that rate cut from the RBA, and we suspect that this move to ultra-low interest rates is starting to unsettle consumers in terms of what it's saying about the Australian economy.
Most analysts expect the RBA to cut rates even further in the coming months.
So once again, if the cutting interest rates hasn't helped the lending so much, and definitely has seen consumer confidence go backwards, why not cut again? Why not do something that hasn't worked before? Just continue doing it, just in case. Or does it have something to do with mid-January 2020, or more precisely 18th of January 2020? And here's the bonus segment.
Ditch the big banks. Borrowers hear the Treasurer's call as small lenders undercut the big boys on rates.
Oh, of course, and our favourite person.
Some of the smaller lenders have actually passed on this rate cut in full, and people should shop around.
That you should absolutely not listen to. Love the shop around thing, the shop around business. Even my mum used to say, what do they mean shop around? I mean, if they're all just as bad, I mean, how can you shop around? When you go from one to another, they haven't passed on the full saving, and they're doing exactly the same thing. And now you think these are third-party lenders, or subprime lenders, as they call them in the United States before the financial crisis. I don't know this, but I can imagine that their fee structure is higher. And potentially you can probably save a little bit if you were to borrow $1 million and buy a house of $1.2 million, which, by the way, next year could be worth about $900,000 and making you a loss of $300,000. This is just a hypothetical case, anecdotal or hypothetical, really, opinion and not financial advice. Just don't be the one who ends up holding the bag.
The big four banks are crying poor. The RBA slashed rates again last week, but they say they can only afford to pass on half of it. A swag of smaller lenders have passed on the cut in full, offering mortgages with interest rates with a 2 in front of them. But with more than 70% of market share, do the big guys need to move? Daniel Ziffer reports.
A cash rate approaching zero. Institutions less than a year old being spruiked by the Treasurer. In banking, these are strange days indeed.
Strange days in banking and in the whole financial markets. But then again, let's not think that these are the strangest days and the hardest days and the most unusual days of times. The only reason why these tend to feel like the strangest days ever is because we are living them. And they're happening during our working lives, during our lives of borrowing, mortgages, buying, selling, making decisions. There are many options. There's Bitcoin, there's cryptocurrencies, then the precious metals, gold, silver, shares, property. There's never been more opportunities and options ever, and that is kind of adding to the complexity, and that makes us think that these are the strangest days, strangest times. In some respects, they are strangest because the interest rates have never been this low, the housing has never been this high, as far in comparison to the people's incomes. Hey, but at least we don't have a First World War, Second World War, and all the other big wars. If anything, since we've had the new United States president, it seems to have been fewer wars than ever. Maybe it's in preparation to the big one, but we can only hope that doesn't happen, and just continue to live our lives, work, invest, play it smart, not be fooled by any YouTube channel or mainstream or anyone else. So listen to everyone, follow nobody, make up your own mind and a decision at the end of the day. That's what I do. Now, if you are for some reason in the market of getting a mortgage, this is a little advice, this is a little research that just popped up, and I've kind of saved this
So
screenshot.
far, only 5 small lenders, including Athena, have passed on the full 0.25 percentage point cut.
So these are the 5. So I'd give him a call if I was looking for it. It's not a plug. I've got no association with these different lenders, but they did mention that the way they can offer lower rates is kind of unfair. Is that they don't rely on any savings depositors. They just go onto the money markets, which still have very low interest rates, and they can get these interest rates very low, get the money very low wholesale, package it up into mortgages and give it to individual people. So I can see how they can actually be more competitive than the banks, who have to get enough savings from people, and part of their money pool is the savings, not just the money markets. So they have to look after the savers somewhat, otherwise people will take their money out of the bank or take it somewhere else. So I can see, once again, in a nutshell, how these five may potentially be more likely to offer a few percentage points better deals. Now, be careful, have a look at the fee structure and how it all works. Not that I would be looking to get a huge mortgage at this time and buy what is way overvalued Australian property by at least 40%. Remember, it should drop by 40%. Now it's down all up about 10 so far, even after Sydney and Melbourne have come clawed back up in the last 3 months of over 3% together. But yeah, let's not forget that they have not come back up to the levels of July 2017. If they break through that level and up, and we have a confirmation for a month or two that they're staying up above those levels nationwide, then we can think that the insanity continues. But until that happens, this is currently still officially a downturn. And ladies and gentlemen, this is what cash looks like, just in case we once in the future are not given an opportunity to have any, to feel or take any out of the bank and touch it.
Some of the smaller lenders and neobanks, the name for online-only institutions, don't fund their loan books from deposits. Instead, they get the money on the wholesale lending market.
And that's the whole crux of the case for going for the smaller lenders, potentially being able to save a few bucks if you are in the market for the mortgage. Just trying to help everybody. All right, thanks everyone for watching. I'll end this video here, and we'll see you in the next one. Take care.